Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And Scarlett, it's our last show of the year.
I know, we need to rest up for 2025. Big year coming up.
Big year. Let's get to the biggest stories right now in the more than 14, now $15 trillion global ETF industry. And as discussed, 2024 has been a massive year for ETFs. We're talking about record launches and investors plowing in unprecedented $1 trillion into funds as well.
So as we look ahead to 2025, we speak with AllianceBernstein's Anita Rausch on why active ETFs are having a big moment.
And we will also speak to John Ciampaglia. He is the CEO of Sprott Asset Management on his Uranium ETF that has blown away the S&P 500 total return since its launch in 2019. But as always, before we get there, Eric Balchunas from Bloomberg Intelligence, he's here with us now. He's looking at the flows. Eric, what do you got?
Katie, Scarlett, I figured this is the last show of the year, so let's look at year-to-date flows. This is largely what I think the year will end at. So, we got a couple days left for sure, but boom, look at this, 102 billion. It looks fake to me. There's never been 3 digits for one ETF here. This would be a record if VU didn't exist. That's how big this number is. And this is double IVV. So this is 10% of all the flows. Again, just a huge year. IBIT also, for a new launch, that's just absurd, $35 billion. We've said all year, the big theme, beta with a side of Bitcoin. That's explained all the flows all year. Here's more beta VTI, more beta. SPY could move up. There's tax loss harvesting flows that could have SPY end up right around here, and we could have the 3 amigos, the 3 S&P 500 ETFs, 1, 2, 3, with about 18, 20% of all the flows. Because at the end of the day, cheap beta still rules. Q's in there for good measure, and AGG was the leading bond ETF. Let's look at the outflows. And what you'll see here is grayscale unlock at the top here. That was that big unlock that, when the Bitcoin ETFs got approved, people left that to go to some of the other ones and elsewhere. Also, ETH is another grayscale. So we have those two on the list. USMV, this is minimum vol. This isn't an easy thing it's easy to understand because in a year like this, low vol, minimum vol doesn't kind of sell very well. So flows out of that. This is like trading crowd flows. We got some inflation-protected outflows there, and HYG with some outflows, but USHY with a lot of inflows. So anyway, let's look at the big picture from the top down in terms of the asset classes and the total number. Also, I just love this chart. I entered the ETF business right here. So like $100 billion in a year was like a pretty big deal. Now, fast forward, $1 trillion. I really didn't think I'd see this day. Back then, they barely had $1 trillion in flows. This is equities. Again, just about a record from 2021. Obviously, all ETFs with a record. Bonds, record. And this is alternatives. This includes the Bitcoin ETFs record. Commodity, not quite. So commodity was the one loser. Doesn't really, obviously in a year like this, commodities won't sell that well. But look, record launches, 30% asset growth. I mean, this is probably as good as it gets, Katie.
Eric, thank you. Let's ask that question now to Anita Rausch. She is Global Head of ETF Capital Markets over at AllianceBernstein. It's great to see you in person, Anita.
Thanks for having me.
So I already asked, but I'll ask again. Is this as good as it gets? I mean, $1 trillion in inflows, record launches. It certainly feels like maybe we're at a top, maybe we're peaking. I don't know.
No, I actually think we're just getting started. And I mean, I've been in the industry for longer than I've cared to admit, and it's always been great years, not always been great years, but it's always been gradually evolving. But I think we've gone through evolutions, right? Passive, smart beta, fixed income, and now active. And then with all of those combined, I really think this is the start, firstly, of the active ETF growth. And I think that's really contributed to the growth this year.
We saw how passive ETFs were eating mutual funds lunch over the last couple of years. But as you point out, active ETFs having a big moment here. Who are they taking market share from? From passive ETFs or from mutual funds?
So it's really interesting, right? Like I said, I've been in the business for a while, and we've all seen that chart of the growth of passive ETFs with the mirror image of the outflows of active mutual funds, right? And we all inferred, or at least I did, that, investors want passive, right? But now the numbers are really showing us that they want the ETF wrapper. They want passive and active in the ETF wrapper. And I really think that's kind of where we're going right now.
Let's talk about this coming year. It's very possible they approve the ability for a mutual fund to just stick on an ETF share class, the way Vanguard has done for like 15 years. If that's approved, my take is that you will probably find some people switching over to the ETF. And the ETF could be used maybe to minimize capital gains for the mutual fund. But largely, I think this probably helps active ETFs also. What do you say?
Yeah, I mean, if it's approved, I think it'll definitely accelerate the launches. I think even if it's not approved, the active ETF launches, in my opinion, are probably set to accelerate anyway. I think it's just going to give it another boost. It's going to be if the share classes are approved, I think it's going to be the best case for all worlds.
So it's not just 401ks or anything like that. We're also talking about potentially endowments doing more of the same. Yukon, for instance, has now been, we have a Bloomberg story on it about how they are steadily decreasing their exposure to hedge funds and instead choosing to put some of that money into buffer ETFs, which of course uses options to minimize losses, but also cap the upside gains. How big of a moment is that?
I think it's a huge moment, right? But I think it's something to be expected, right? It's what the ETFs are revered for. They're revered for cost efficiency, then they're revered for liquidity, and they're revered for ease of use. And I think that's what we're seeing in this story. They're going away from the hedge fund, getting that same risk management strategy in the ETF wrapper at a cheaper cost with anonymity and more liquidity. So it's exactly why ETFs sort of have had that run over the past 30 years and why I think they're going to continue to run, because there's still so many white spaces to be taken up.
Well, there's definitely white space when it comes to the investor base, of course. Endowments, a great example. It's going to be interesting to see if we see more uptake there. But when it comes to the product landscape, I mean, where haven't ETFs touched yet? Where do you think the white space still is from a product standpoint?
Yeah, I actually think that's a great question, because it's something that a lot of people ask all the time. But you know what? I think, and what's shocking to see is, but it's in the numbers, right? Active ETFs have had such a great year because there hasn't been a lot of choices for active ETFs out there. And so the demand is there and not the supply. And I'll just point to fixed income in particular. In the mutual fund world, over 75% of the over the 75% of the mutual fund fixed income assets are active. In the ETF world, only 10% of the fixed income ETF assets are inactive, and that's purely because there's not enough supply. And so I think, well, obviously I see a tremendous future for active fixed income ETFs, but that's sort of the white space that I'm thinking about. It's really in the active world, just filling in the niches of demand that's not already there.
So when we met, you have a big background in capital markets. You know the mechanics of ETFs very well. I think that's where we met on a panel about ETF mechanics. Spider wants to launch a private credit ETF with Apollo. To me, this is a big thing we're looking to next year. This could open up a whole new active world, too. What do you think, as someone who has worked behind the scenes in making markets, can you pull this off? If Apollo promises to be the liquidity backstop, can an ETF like this function? Will it function? Will it open up a whole world of putting in these illiquid assets into a liquid ETF?
Well, listen, I'm not going to comment on whether this particular one will work, but I really think the unicorn is putting in the private assets into the ETF for the liquidity, but more so actually for the accessibility, I think, is what everyone's kind of going for. But that's what we in the ETF world have done, right? We've looked at a challenge, we've figured it out, we've created new solutions, we've spoken to lawyers, we've crossed our fingers, and we've launched it. And so I think that is definitely the next bastion. I don't know if this is the exact formula, to be honest, just because I haven't looked at it, but I really think that we will figure out a way to do it.
Interesting. So not on this specific filing, but, you have heard people say that, maybe we have found the limit. Maybe we don't need to put private assets in a very liquid, obviously, intraday trading vehicle. But it sounds like you're saying that the liquidity mismatch may be a little bit overblown?
No, I don't think it's overblown. I think that's definitely the question mark, right? You can't put something superiorly illiquid with no daily liquidity in a daily liquid wrapper without creating sort of, like you were talking about, a liquidity backstop, right? So I think that is the question mark and the formula, and that's what I think we as the industry are geared towards solving.
Is there any asset that's not appropriate in an ETF wrapper?
Well, yeah, I mean, first of all, yes. But I think it's sort of what we were talking about, right? First of all, you need daily liquidity, and transparency has helped. I know there are semi-transparent ETFs, but the daily liquidity is really what creates the robust and efficient ecosystem. And if you can solve that on the back end, even if it doesn't exist now, then it'll work in the ETF.
All right, Anita, great to get some time with you. Really went around the world there. Appreciate your time. Happy holidays. That is Anita Rausch of AllianceBernstein. Now, coming up, we'll discuss the recent Bloomberg ETFs in Depth conference and what investors had to say as we head into 2025. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF Brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And Scarlett mentioned this earlier, but we're keeping an eye on the University of Connecticut, the endowment shifting away from hedge funds and turning towards buffer ETFs. Of course, buffer ETFs, very popular right now. They shield you against downside losses in exchange for a cap on upside gains. You can see the flows have been on fire over the past couple of years, and endowments starting to add to that as well. But let's move on and talk about one of the other hottest trades in the ETF industry, and that is leveraged single stock ETFs. On average, they're pretty expensive, charging 1.1%, but leverage shares launched two such products last week that only charge 0.75%. So fee wars, they're a feature of the ETF industry, and of course, leveraged single stock ETFs are no exception. But Scarlett, I do want to end with some of the big names that have entered the ETF market this year. This has been a growing trend, and just really in the past couple of months, you have Nouriel Roubini, who we've had on the show, and Tom Lee from Fundstrat enter the ETF space, and both of these names were live in person at our ETFs in Depth conference last week.
All right, so let's follow up on this and bring in Eric Balchunas, who, of course, kind of put together the whole event. So, Eric, you kind of had a boom and bust, a bull and a bear on stage. What did we learn from Tom Lee and Nouriel Roubini?
Yes, people were calling it boom and doom.
Like that.
It's perfect. It was the two bookends for our conference. It'd be interesting to get those two guys together. I'll be honest, I would grab the popcorn for that. Tom Lee, very bullish, very optimistic on beta with a side of Bitcoin. His granny shots was a great metaphor for picking non-cool stocks, and he's doing well. To his brand power matters a lot. There's hundreds and hundreds of ETFs, so for him to get those assets is good. Roubini has this Atlas America. Now, this one's really the stuff that will benefit if inflation goes wild, the 60-40 kind of implodes, like in 2022. So he painted a grim picture of what could happen, and if that happens, they're buying all the stuff like real estates, tips, inverse treasuries, gold that would go up in that scenario. So two very different visions of the world painted here. But hey, this is a Big Ten industry, and I think that's okay.
And of course, Roubini was the last speaker, so it made everyone really want to grab a cocktail. But that was last week. Fantastic event. I know you've been putting it on for about 9 years. Let's talk about the year ahead, because Bloomberg Intelligence also releases, of course, year ahead forecasts. What do you see in your crystal ball?
So we see more growth. This year, global ETFs grew by 32%. That's insane. We're predicting 10% a year growth going forward. That gets us to $35 trillion in 2035. But we don't think the market's not going to be this generous every year. So we think a lot of growth will happen. But if you want to get specific, we've got this new SEC chair, Atkins, probably going to be way more libertarian, looser than Gensler. So we're looking for things like the ETF share class. If that's approved, that's going to be big. We're looking for the private credit ETF. Obviously, we just talked about that. That would open up a whole new can of worms. And then the altcoins, XRP, Solana, this whole Bitcoin Ether thing might just be the beginning. This could be like a whole Pandora's box. Where does this SEC say enough is enough? If a Dogecoin ETF gets filed, or they say, nah, too far? I don't know. So this is the new SEC chair is really going to be an interesting element this coming year.
Is it the new SEC chair then that decides whether ETFs can be in 401ks if you want to stock your 401k with ETFs rather than mutual funds?
So that's something interesting that came on the panel. Ciampaglia said she had a dream that ETFs would be in 401k plans. Look, Spider is actually, a lot of people want an ETF share class of a mutual fund. Spider wants a mutual fund share class of an ETF. Because in a 401k plan, because you don't want to buy an ETF and pay the spread every day, it's technologically not as great. Plus, you don't need tax efficiency in a 401k plan. You can get low cost through your institutional mutual fund. ETFs lose a lot of superpowers when you put them in a 401k. So they're not the need isn't as great, but she's still going to try. I think we might see some movement there. But I still think 401k plans will be mutual funds Alamo for a long time. I think they're really going to bunker down there, and that's where mutual funds will have their assets. But anything out of that, probably ETFs are going to clean up.
Yeah, that seems to be the use case for those mutual funds that have seen their assets really bleed in the last decade or so. All right, Eric Balchunas, of course, with a review of ETF in depth, and of course it comes back next year, next December?
Yeah, it'll be the 10th one next December, by the way. We're going to have to really think of something good.
10th anniversary coming up. All right, still ahead, we're going to drill down into a red-hot uranium ETF with the CEO of Sprott Asset Management next. And just a reminder, you can listen to Eric and Joel Weber on Trillions, their podcast that covers the ETF industry. This is ETF IQ. This is Bloomberg ETF IQ. I'm Scarlett Fu along with Katie Greifeld.
And it's time for today's drill down where we focus on one ETF. Eric, hit it.
Katie, today we're going to end the year with a bang. We're looking at URNM, the Sprott Uranium Miners ETF. This thing came out in 2019. And it's funny, I noticed it when it came out because it was 10 years of just miserable performance for this sector. And normally you don't see that. ETFs typically launch after a big bull market, not a bear one. So it caught my eye, and look, you can see here 75 basis points. You can see the inception date there. It's gathered at $1.5 billion. Why? Because the performance has been really good. So this tracks companies that largely are involved in the mining of uranium. As nuclear becomes more acceptable, this has gotten more interest in terms of people, buying up the stocks and raising the performance. So let's look at what it holds, and you can see here, you may or may not recognize some of these companies here. Cameco at the top. A lot of people know this name. And then some other miners. But then this is interesting. This is the physical uranium trust that you have in Canada. They're trying to file one here in the U.S. next year, but there's no physical here. It's like GLD for uranium, but they have that at 10%. So you have or 11%. You have uranium in there, and then the rest again, more companies here. You can yellow cake. You can tell it's very uranium-ish. All right, let's look at the performance of this versus SPY. Unbelievable. So since inception, this thing's up 300%. SPY's up 100, and S&P's done really well. This is solar stocks. So to me, this is like the new green play right here, or it was. And then here's physical uranium. So URNM actually did better than physical and crushed everything, Katie. And that is why a small indie ETF like this can have $1.5 billion in assets.
All right, Eric, thank you. And joining us now to talk about this ETF, I'm thrilled to say we have John Ciampaglia. He is CEO of Sprott Asset Management. John, great to have you with us on our final show of the year. This is an interesting one because you're tracking the miners. A lot of people pay attention to the price of uranium. Maybe that's the first thing they check. What is the case for investing in miners versus, of course, the actual thing that they're mining?
Yeah, thanks for having me. It's great to be on. So with all commodities, people have to, I think, initially start with what is their view on the commodity itself before they make a decision on whether they want to get involved in the mining companies. And as Eric pointed out, the price of uranium has been one of the best performing commodities of the last 5 years. And that obviously was following a very dark period in nuclear energy where the price was at incredibly low levels that wasn't economic for most mining companies in the world. But that has obviously shifted. So with the commodity price coming back to life, I would say in 2021, that has obviously really helped to resuscitate this sector. This index is comprised of the two largest producers of uranium in the world. One is in Canada, one is in Kazakhstan, and then a bunch of the smaller producers, as well as some emerging producers and exploration companies. So you're really trying to capture the operating leverage to higher prices, as well as optionality through some of the more earlier stage development plays in the index.
Right, gotcha, John. So I feel like geopolitical tensions, whether you're talking about Russia, Iran, or China, will disrupt the uranium supply chain and also support prices at the same time. And there's been no shortage of 2024 geopolitical headlines. Yet, you look at prices, they did soften this year. What's the reasoning behind that? And what does that mean for how you look at geopolitical tensions and where prices go?
Yeah, I think it's fair to take maybe a step back and talk about uranium just 3 years ago. That was around $30 a pound. And now we're at around $80 in the spot market. So I think it's fair to say that the geopolitical tensions in the world over the last 3 years or so have helped propel the commodity price higher. It's not just the price of uranium that has gone up. It's many of the stages of the nuclear fuel cycle, which Russia is very involved in, that have gone up even more than the price of uranium. So if you think about The enrichment price for uranium, that's gone up around 400% since the war broke out. So the whole supply chain has been very impacted by this. The other factor geopolitically is that 40% of global uranium actually comes from one country, and that's Kazakhstan. And I think it's fair to say that the sphere of influence by Russia on Kazakhstan over the last couple of years has definitely intensified. That has created some bifurcation in the market, and I think some anxiety for Western utilities because they're just not as comfortable in terms of putting all their eggs in one supplier's basket, so to speak. So we have seen geopolitical tensions definitely impacting the sector since February 2022.
And John, I want to talk about a catalyst that is AI. AI demands so much energy. We've seen Google, Microsoft, Amazon buy or build their own mini reactors. How much demand could the AI push be for uranium as maybe a percentage of all demand?
Yeah, it's really fascinating. And obviously, when we got involved in uranium a few years ago, we were just thinking about a very simple supply deficit that was based on largely, kind of a flat number of reactors. Now that's changed remarkably over the last few years as China has signaled they're going to build over 100 more reactors. And then more recently, big tech is stepping in here and supporting the development of small modular reactors. This is kind of the fourth generation of reactors. Now, why this is so important is, as you mentioned, AI data centers are very electricity intensive. And so what the big tech companies are trying to do is bring their own power. They know that the main obstacle they face is not the data centers, building those, it's not the code, it's not the chips, it's the electricity. And you can imagine the mismatch between the pace at which utilities operate and build new capital infrastructure and how fast the tech companies are moving with AI. So they are essentially signing these massive, power purchase agreements for everything from solar to wind. And more recently, they have figured out they need to include nuclear power in their mix.
Right.
Now, remember, big tech is very focused on clean energy and net zero targets. And if you think about what nuclear power provides, it's clean energy, no greenhouse gases. It's firm,
Right.
meaning no issues with intermittency. And it also is very energy dense, which means
Right.
you can create nuclear energy on
John,
a very
unfortunately, we
small
have to
amount of
leave it
time.
there. Up against the clock. That is John Ciampaglia of Sprott Asset Management. Quick programming note, we'll be back after the holidays in the new year on January 6th. Really appreciate, of course, you tuning in over the course of 2024. Have a happy holiday season when you get there. This is Bloomberg ETF IQ. We should have put the newsletter promo first because it was weird to